Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we have Brien Lundin on the show. Brien is CEO of Jefferson Financial, publisher of Gold Newsletter, and host of the New Orleans Investment Conference. Brien, thank you for coming on the show.
Great to be with you, Steve. Thanks so much for the opportunity.
Pleasure's all on this side of the table, sir. We're going to start out with your story, then get into macroeconomics and the Fed, interest rates, your favorite commodities right now. You've got a few listener questions, and then what I'm excited about is your special offer to the Hive, which we will get to at the end, so stay tuned. So let's start off with your story. Go ahead and give us a couple minutes on your background, how you got into commodities and precious metals.
Sure. You know, everything that we do, Gold Newsletter and the New Orleans Investment Conference, was started by a brilliant guy named Jim Blanchard in the early 1970s. He was actually a school teacher when he heard Nixon announce that he was severing the dollar's link to gold on August 15th, 1971. And at that point, he knew what would happen. He knew that that would kind of unleash the inflationary pressures in the U.S., and which of course happened. But at the time, it was illegal for Americans to own gold other than as jewelry or rare coins. So there was no way for American citizens to protect themselves from the inflation that was about to come. And Jim vowed at that point to advocate and lobby for the return of the right of gold ownership to American citizens. So he started Gold Newsletter as a way to do that, kind of a propaganda organ for for the nascent gold bug community in the U.S., and really launched the sound money movement that flourished throughout the 1970s and really since. So he was successful. He did a lot of crazy things to get attention to the cause and lobbied on Capitol Hill. They were successful in doing that, he and the other people who were working with him to do it. And at the end of 1974, it was signed into legislation, and citizens could once again own gold. But they knew it was going to happen by mid-year, and Jim decided to have a conference to teach U.S. citizens, teach Americans how to buy gold. And he did so, and that was the first investment conference that he ever put on. He had an overwhelming response, and that's carried on today, and it's known as the New Orleans Investment Conference today because it's always been held here in New Orleans where Jim grew up. I started working for Jim as a junior copywriter in 1985, and by the end of that decade, by 1990 or so, Jim had sold his coin and bullion company to one of the first hedge funds out there. And took me to run what was left of his company with the conferences and the newsletters. So I've been running those since about 1990. And Jim passed away in 1999, and I purchased the majority interest in the company that I didn't already own from Jim's estate. So the past 24 years, I've been trying to keep that legacy going with the New Orleans Investment Conference and Gold Newsletter, both of which stand as the longest running, oldest, and I think most respected organizations in their fields. The Gold Newsletter is the oldest precious metals advisory continually published in the world today. It may be the oldest newsletter at this point, investment newsletter. And the New Orleans Conference really started the whole retail conference business. It's the oldest retail investment conference going on in the world today. And we just continue to try to build on that legacy by providing our readers and subscribers and attendees with far more value than they paid for. And that's, the most simple and effective marketing policy you can have, most effective marketing strategy you can have. And it's really what we focus on every day.
That's cool. All that from a school teacher. That's pretty impressive.
Yeah.
So you've been doing this newsletter for like 3 decades, right?
Yeah, I started in '85, so this is my 38th year.
Almost 4.
I wouldn't be able to say I've been in it for 40 years and not just spanning 4 decades, but been around a while, Steve.
Yeah, so you've forgotten more about gold probably in the last month than we'll ever know. I like that.
Yeah, but I can't remember what I had for lunch yesterday, so that's not saying an awful lot either.
All right, let's do the Adam Taggart. What is your macro view of the world economy and financial markets today?
Yeah, it's fairly simple and I think fairly obvious, but I don't think that many people really consider it or look at the facts. But if you look at the the Fed funds rate, for example, going back to the early 1980s, when Paul Volcker killed off inflation, and after he raised the Fed funds rate to over 20%, every successive Fed governor and Fed chairman has had the same policy prescription, the same reaction, the same solution whenever there was any hiccup in the economy or a recession, and that's that they lowered rates. And once the crisis passed or the recession passed, they attempted to raise rates and normalize them again, but they were never able to get past the midpoint of the previous range before they would have to lower them again. And if you look at the bottoms of that interest rate cycle, now 40 plus years in length, you see that it's just a steady stair step downward until they reach zero in 2008. And over that period, the financial markets, the investment markets, and really the entire economy became increasingly addicted, not to easy money. And that's the mistake a lot of people make. They say they got addicted to easy money. They got addicted to ever easier money. So whenever the crisis came up, the next crisis came up, they would need easier money than they got before to get the same reaction. They developed a tolerance for the drug, in other words. So you saw in 2008, the Fed immediately, not immediately, actually over the course of a few years, lowered rates to zero, came out with quantitative easing, came up with a lot of acronyms for programs like TARP and the like, and were really unprecedented in the amount of the degree of monetary liquidity that they threw onto the markets. So that was really astonishing. But then came COVID, and everything that they did before over 4 to 5 years, they literally did over 4 to 5 days when they shut down the economy because of COVID. And that has set us up for what we're seeing today. Yet another crisis in the making. We've seen the lowest or the easiest monetary policies in human history over the last 12, 13 years. And now the Fed is forced to counter that with one of the harshest tightening cycles ever seen. So my view is that we are in kind of the end game of this multi-decadal cycle of ever easier money. I think the Fed is fighting a losing game because Powell does not have the same toolbox that Volcker had. Federal debt now is 125% of GDP. When Volcker was tightening, it was 35% of GDP. Yeah. So with debt this large, we simply cannot operate with interest rates this high. Moreover, we can't operate with interest rates that are even positive on an inflation-adjusted basis because the debt burden is so crushing. So we are in this end game, and there is another crisis because the cycle keeps turning. There's another crisis brewing. It's somewhere ahead. We don't know precisely what the precipitating factor is. We don't know precisely when it will be, or what path it will take once it starts. But we do know what the Fed's reaction will be. They will do something. They will come out with a rescue operation, an influx of monetary liquidity that will overshadow anything they did before. True shock and awe, because they will need to hit the markets with this shock and awe. So we don't know what's going to happen or when. We just know it's going to happen, and we should have high confidence that we'll want to own gold, silver, and in associated investments going into what lies ahead.
Yeah, so I hear you saying when Volcker was in power, their debt to GDP was only 30%. Now it's 125% of gross domestic product. So to
Yeah.
put that in perspective, if we didn't take on any debt for a year and what is that, 3 months, then we would finally pay it off, right? By producing as a nation for 15 months, then we relieve the debt. I've seen also that we've gone from 32 trillion in debt to 33 trillion inside of a few months. We just added a
Yeah.
trillion worth of debt just inside of a few months. And
Yeah.
you don't see this process as sustainable. And one way to really place a bet on the other side as insurance is in precious metals.
Yeah, there's only a few ways that you can address a nation can address debt. They can raise taxes, but the debt's so large now that you could, as you say, you could take everybody's output, take all of their income, and you still wouldn't eliminate the debt. Um, so that's not really feasible. You can grow your way out of it, but the debt is again too large to do that. You would have to grow the economy by, the kind of growth rates we saw China doing in the 2000s, double-digit rates a year before you could really eke away the debt. And of course, there's the spending side of the equation, and you're not going to get the politicians to cut spending, especially when entitlements make up the vast majority of all spending today. So, and even if we were able to grow our way out of it, or have those rates of economic growth, the politicians still spend every cent that came in, every additional cent that came in, and find ways to expand the debt. So you really can't get out of this trick box right now. You can, people talk about inflating your way by devaluing the currency. I don't think that's a strategy that any government official will actually undertake, because the rates of inflation or depreciation of the purchasing power would have to be so great that it would be self-destructive. However, that's kind of what happens when your back is up against the wall. It's kind of what evolves as the policy that you have to undertake, because you have to make those interest payments, and you have to make them, and you have to create the money to do that. So that creates the inflation as a byproduct of the simple cold hard fact that the government has to pay its debts. So we will have much higher inflation, and we will have a steady depreciation of purchasing power of the dollar in the US. But it's not just the dollar, it's really all of the major fiat currencies in developed nations around the world.
Okay, so we kind of hit on interest rates right there. Are you in the camp that I'm going to share my screen here, and this is the EDV, basically like long duration debt. Here's TLT, basically 20-year IEF. This is 7 to 10-year bonds. Do you feel like we're I mean, when I look at it, this is a technical trader. This is going back 15 years. I mean, there's only been 6 points where we've been down this low, and they've just all had dramatic increases. Is this a stupid bet? Am I, should I not be placing this? What are your thoughts on? Because if the Fed starts cutting, this is going to do very well, right? But if they don't and they go higher for longer, we're going to have egg on our face. How do you feel about bets like this, or is this just a fool's errand?
No, I think obviously if you try to leverage that and you do it in futures where you have time decay and the like, you have to time it. And I think that's the dangerous part of a trade like that. We don't know when it's going to happen. We know that there's going to be, the candidates for a precipitating factor of the next crisis that will force the Fed to pivot. The list of candidates are long, and the ultimate factor is probably going to be something we haven't thought of or haven't mentioned much. It's probably going to come out of left field, because
a black swan.
Yeah, that's just the way things happen. But we know that it's coming. That the question is when. So I think that kind of a bet is a good one, because it's going to absolutely sing when the Fed pivots. And we know that the Fed will have to pivot at some point. That's just the way things happen. That's just the kind of cycles we're stuck in because of this long-term trend. So yeah, I think if it's something that you can bet on and hold for a while, it would probably work out. Akin to that would be, simply gold and silver. I think that's a long-term bet. When the Fed actually pivots, and over the even longer term, as currencies lose more and more credibility in the public's mind, all sorts of tangible investments are going to really pay off. It's going to be back to commodities and things, real estate and the like. So all of these things can pay off. I think the surest bet among all of them from a monetary standpoint are the monetary metals, which really are gold and silver.
Okay. Okay. All right. Maybe you just answered this, but what would be your favorite choice of commodities for the next 5 and 10 years? Paula wants to know.
Yeah, that's interesting. I would say, from a monetary standpoint, gold and silver, because I think those fundamental forces are, irresistible. I think the Fed will have to pivot at some point. We don't know again precisely why or when, but we know it's going to happen. Probably not too far off in the distant future. And when it does happen, you're going to have gold really soaring well past the old highs and setting new records and getting into uncharted territory. For different reasons, but with similar long-term potential, I would say copper. The electrification trend, electrification of transportation trend, really copper is in the sweet spot for that, because it's not only used to a great extent in electric vehicles, but it's also used in the grid, the electrical grid, which will have to be essentially rebuilt to provide the power for those electric vehicles. So there's no getting around it. There's no substitution for copper in those usages. And there's a really dramatic supply constraints on copper right now. It takes 10 to 15 years from discovery to production of a new copper mine. And there's been very little money spent over the last decade or so in exploration and development. So it takes a long time for the copper market to respond to demand pressures. And those demand pressures, the demand curve for copper is perhaps the steepest we've seen for any commodity in recent history. So I really like copper, but as with gold, timing's that's the rub. What's the timing? I think copper is one of those things that you set it, forget about it for a few years, and just feel fairly confident that in 3 or 4 years, if you picked your investments well, they're probably going to be worth a whole lot more than you're paying for them today.
Okay. All right. Yeah. Copper typically doesn't do well in recessions, right? So we might have a drawdown here. As it sounds like you're in the camp like we are, that we're going to hit a recession. And when we do, copper will probably get drawn down. And that's simply the time to double down, because the narrative hasn't changed at all. The deal just got better, right?
Yeah. It's not something where you want to jump in head first, because that is that will create the wiggles in the line on the long-term uptrend. For copper, is because the headlines on China, the potential recession, these are all potential negatives for copper going forward. So I would take advantage of those in a long-term holding account, if you can segregate things that way, and take advantage of significant dips in copper.
Okay. All right. And probably the same thing, maybe we should say that for gold and silver as well, right? When the recession hits, as Rick Rule says, anything that has a bid gets sold, and it's not sold because they think it's a bad deal. It's sold by the margin clerk, right? So, and
Yeah.
since gold and silver are money itself and payment itself, they're going to get drawn down as well. But if you think you're going to time this by going and getting coins at a great deal when this happens, the swings daily can be 75 or 150 bucks. You're not going to be able to get it. You want to have your position before. But you may be able to time this a little bit with some of the miners, or maybe even the junior miners, correct?
Yeah, you can. And I think you want to accumulate, because again, the timing's the tough part. you want to accumulate, you want to be positioned now for this kind of big macro picture we see. But you always want to have some cash on hand. You want to have some powder available for when the opportunities emerge. And when you have a crisis emerge, it's typically a liquidity event. We saw it in 2008, where the price of gold would swing $100 in a day or two, upwards and downwards and back upwards again. And we saw it post-COVID, and when we had this massive sell-offs. So that's the time, if you can have some cash, have some dry powder, you can spring into action and take advantage of those bargains. And that's what happens. The rebound is so quick in those instances because everyone understands what's going to happen and what the Fed's reaction will be and must be. And again, the next time it happens, what they do is just going to blow your socks off.
Okay, we're at about 20% cash in the model portfolio. Does that seem like a good number to you, or is that not enough or too much?
Yeah, well, generally speaking, I can't talk about anybody's individual portfolios or give any individualized investment advice, but generally speaking, that sounds pretty good. Also, there's gold bullion is the ultimate liquidity, and typically, in a liquidity event, it's one of the piggy banks, if not the ultimate piggy bank, that's broken into to meet margin calls. However, there's not a lot of professional traders and hedge funds and the like that own gold right now. So if we had a liquidity event tomorrow, I don't know that we would have the same kind of response that we saw in 2008, for example.
Okay.
But yeah, cash, generally speaking, it's good to have it lying around, understanding that it's a burning match, and it's depreciating by 4 to 5% a year by the official estimates, and probably much more in reality.
Yeah, yeah. We got almost all of that in rolling treasuries that mature every week. So then, every week we got a few percent that we can fire. Okay. Interest rates, Black Swan, we hit that. Okay, let's go into gold here. I'm going to share my screen, and you can see the gold chart, Brian?
Yeah.
Okay, so this goes back, courtesy of TradingView, this goes back almost 200 years. And so we can see what happens when governments don't print currency, and then all of a sudden when we get off the gold standard and they print like drunken sailors. And then this is the last, I don't know, since 2011, so the last 12 years or so of gold price action. And this is the pattern that we are exceptionally excited about. And this is called a cup and handle right here, correct?
Yep.
And typically when you have this pattern, it breaks out pretty dramatically to the upside. And you probably know the technicals better than I do, Brian, but you typically take the time that it takes the cup to form, correct? Which is, in this case, it's 9 years. And then how long does it usually take for the handle to iron itself out? Is it about 30 to 50% of the time of the cup?
Something like that. I don't know that there's a hard and fast rule. You may be more up on that than I am. But I do know that pattern, and you've pretty much drawn it correctly right there, that the resolution of that pattern points to a minimum of $3,000 on the gold price. And consider that, we're dealing with different numbers for those of us that have been in the market for as long as we have. If we go up 15% in the gold price right now, we're going to be, $2,300 on the gold price. And we've seen the gold price go up 15% in a couple of months on occasion with the right kind of stimulus.
Yeah.
So we are on the verge of uncharted territory, and that pattern is the most powerful and compelling, not just in that we've seen in the gold market for many, many years, but in just about any market out there. It really is pointing toward a massive breakout. Again, we're not sure why or when, but we do know that the way these cycles work, it is coming.
Okay, and you get the $3,000 target by taking the low of the cup to the high, which is a difference of about $1,000, almost to the dot. And then so we basically take where the high is here and draw another $1,000 leg up, and that brings us up to 3K. Is that what you see?
Yeah, and it can be much higher. And again,
Okay.
we are at that point well into uncharted territory. And there's an end game to talk about here, and people talk about the Great Reset. That's something that is going to happen, in my opinion. Again, whether it's this boom bust cycle that's about to come, or the one after that, or the one after that, but because the Fed and the central banks respond to every such crisis with an overwhelming flood of liquidity, of new currency creation, it eventually that's going to become embedded and anchored in the public conscious that these paper bills are going to be worth much less when that next inevitable crisis comes along. So they're going to lose more and more respect, more and more credibility. At some point, there's only one way you can restore credibility, one proven way you can restore credibility to a currency, and that's to attach it to gold. And that can happen, and I think it's going to happen. And to the point of that price chart, when that does happen, to have even a 20% backing of the US money supply, you're talking at about $10,000 on the gold price and more. So it can happen. I think it will eventually happen. And one of the interesting things that you don't see talked about when people consider this is what the options may be to anchor the currencies to some type of a standard. They talk about a basket of commodities, and the like. But to do that, you're going to have to be able to artificially or by fiat dictate the price of those commodities. And gold is the only commodity, the only element in the world that you can multiply its price without disrupting any industry.
Yeah.
Whatsoever, because its value, it's used in such minuscule amounts in anything but jewelry. But in any kind of an industrial application, it is used in such small amounts that a multiple of its price would not affect the end price of the product very much at all. And jewelers can always adjust. They'll be very happy to raise their prices for items that their costs are at, under the previous price regime, and then they'll just lower the carat standards of their jewelry. So it is really the only option. Interestingly enough, gold is the perfect money.
Yeah. Okay, so if we want to play the beta in this, well, first and foremost, your ultimate insurance are the physical gold bars and coins.
Yeah, absolutely.
And then, that's pretty easy math from 2,000 to 3,000. You got a 50% run up there. And if we wanted to play a little more beta, we could play things like GDX, maybe Barrick Gold, wheat and precious metals, stuff like that. That's probably going to have a 3x move in that ballpark from 2,000 to 3,000, right? And if we really wanted to play some alpha in this, then it would be, some of the mid-tier and junior miners, because let's just call the price of gold right now 1,900, and let's say it goes up to 2,000. Well, that's $100 increase. Well, if you have a miner and they're, making $200 an ounce, and it goes up by $100, now they're making $300 an ounce, right? They just increased their profit by 50%. Whereas if you got the gold coin, you made $100, right? Instead of a 50% move in profits. Is that the logic behind it?
Yeah, absolutely. What's referred to as the marginal gold producers, the high-cost gold producers. Interestingly, the worst companies become the best investments because they have lower margins, therefore, or in some cases, no margins. They're barely keeping the doors open, barely producing at current prices. But when prices go up, their profits multiply. They may not only go up, 20, 30, 40%. Their profits may actually multiply. and then they get applied the same kinds of multiples as their peers. So they really are highly leveraged to an increase in the gold price. They're riskier in that a decline in the gold price does the same thing. It can send them into a loss-making situation. So there's a bit more risk, but that is one way to do it. And another way, of course, are the juniors, which tend to offer more leverage than the major producers.
Okay. All right. BG and Wolfgang want to know about Mexican mining risks. So, nationalization risks. Are these titles even safe? How concerned should we be in our Mexican miners' bets?
Yeah, there's some risk there. There's a recent government rulings that place or are attempting to place very severe restrictions on mining, and particularly mining development in Mexico. And these are the kinds of cycles we go through in a lot of governments, not just in Mexico, not just in Latin America, but around the world, where when prices of metals are low, governments encourage companies to come in and explore and hire their people and develop industries. Then when prices go up, they look at them and say, well, let's renegotiate. We want some of that money you're making. And AMLO in Mexico has some other motivations, environmental, more socialist, collectivist, and the like as well. So there are these cycles that governments go through, and it's in the U.S. as well. The issue, or the thing that you have to realize when you invest in, say, a junior mining company that's operating in these countries, is that you're not in that investment to see something go from grassroots discovery to producing cash flow. You're in there for a small window of time, which may be 1 or at most 2 years, where somebody or that company comes in and makes a discovery, drills it off, and has a very rapid price gain as the scope of that discovery is realized. Then you want to get out. That's the key thing. You don't want to stay in for the long term. So your risk in not just Mexico, but a lot of these regimes is mitigated by the fact that you're taking a slice in time where you only need that country to hold together. You only need it to stay off the headlines in the major media for that small slice of time. Another way to mitigate that is by holding these juniors in spreading your risk over geographically. But you can only hold so many of these juniors in a portfolio. You wouldn't know that by looking at my portfolio, but you really should limit it to the number that you can adequately track. But spread your risk over a number of jurisdictions is the best way to address that kind of risk. And I certainly wouldn't have the majority or even a large extent of my portfolio focused only in Mexico.
Okay, that's good to know. That's so we're not holding these long term, for 10 years, hoping they finally pull it out of the ground. You're trying to capture that amazing drill result where they find a pocket down below and the price reacts. Okay.
Exactly.
All right. BG wants to know, why have precious metals miners done worse than almost all other mining sectors? For example, uranium, lithium, and copper miners. Are their costs disproportionately greater? Is the sentiment in the sector worse, or is something else the cause?
Yeah, I think, well, copper miners, I don't think have done that well. I think that's a play over the long term again. But, the other two are lithium or energy metals, energy related, and even copper goes to that story of the electrification of transportation and, that powerful fundamental demand curve that all of the energy metals are facing right now, and also high prices and some really impressive price spikes, particularly in lithium. You don't get that, or haven't gotten that, in gold. People look at the gold price now, we're within 8% or 10% of an all-time high in gold right now. So miners should be doing great. They should be flush with cash and money should be pouring in. But the key distinction is that markets don't care what the price of a metal is. They don't care where the price is. They care where the price is going. So until we get a strong and consistent uptrend in the gold price, then we won't see the silver price respond. We won't see the miners respond. But once we get that consistent uptrend, we're going to see them respond like gangbusters very quickly, because we're already near these highs, and these companies can just rake in the cash when at prices just a little bit higher than they are today, even at current prices. But when you see that uptrend and analysts start factoring in, say, $2,200 gold into the production profiles of a lot of these companies, and seeing how undervalued they are right now relative to the metals at the lowest levels, the cheapest prices relative to metals prices we've ever seen, then you're going to see, again, a flood of money into the sector, and they're going to respond very quickly and very dramatically.
Okay. All right. DeWaldebear wants to know, how do you see the future of Australian miners with regards to the current partial unwinding of global supply chains?
Yeah, that's an interesting question. I think Australia is a different market than the North American mining markets. It's a bit stronger right now than, say, the Canadian markets or the Canadian listed companies. I think the future is quite bright. Of course, I think the future is quite bright across the entire sector, and it's not really limited to Australia. So I think the future looks good. I'm bullish on that sector. But again, I think it's across the board. And generally speaking, I think the Australian market will respond more quickly to these positive fundamentals, but it's already responded better to begin with. So the values may not be quite as extreme as we see in the North American markets.
Okay. And Jeffrey Spalding wants to know, we've got Wolfgang in here too, and he's our #1 fan from Germany. So we'll throw Germany under the bus as well. Why is Australia and Germany avoiding nuclear power?
That's an easy answer, because they're stupid. They really are. I mean, it is the only viable green energy alternative, the only green energy alternative that can supply baseload power and not intermittent power, and grow with the power needs that we're going to have with this electrification trend that we just talked about. So there's no way to avoid it. You'll need it. And Germany and Austria and the like, they may not want it. It may be a case of NIMBY. They may hold their noses and allow some to continue to produce. They may suffer along with their green energy initiatives, but eventually they're going to have to import it, because it is the only viable long-term energy source out there. So they're doing it so politicians can address the electorate and keep elected and keep their offices. But so until politicians can find real jobs, you're going to see this sort of lunacy. And that's simply the case. And I don't see them facing reality anytime soon, unfortunately.
Okay. Our big thinkers are thinking small. Okay, Wolfgang wants to know, what is Brian's take on oil in general, and then also Africa oil's situation and future?
Yeah, interestingly, oil demand and internal combustion engines demand, autos, is still growing worldwide. So I'm bullish on oil right now. I think it obviously has a $100 handle in mind, and we'll get there. Africa oil, I think Africa in general is a tremendous frontier for not just oil production, but mining and minerals production in general. It is an untapped frontier, but I don't think you can talk about Africa homogeneously. It really is a massive continent, massive area, and extremely diverse in not only mineral, metals, and energy endowment, but also politically. So it is, people make the mistake of looking at Africa as a monolith, and only in very few ways can you look at that. You can look at China and Russia's attempts to infiltrate Africa in general, but even that really, that it's only in a few specific areas. So the most interesting thing about Africa to me is that it is the only region on the face of the planet where the population will still be growing in 20 years. And eventually, Africa will rule the world in terms of population and hopefully economic development. So it's hard again to look at it monolithically, and I don't think you can, in particular with oil, but in oil in general, I'm bullish on it. But then again, right now, who isn't?
Yeah, yeah, yeah. We got a gift at COVID when it went, $30 a barrel or even negative. And I think we got a gift not too long ago when it hit like 63 or $65 a barrel. That was a tick if you could catch it. That was fun.
Yeah, and we got that well-timed SPR release, huh? Wasn't that a beautiful thing?
Right?
Yeah, we're going to replace that anytime soon.
Yeah, I was talking with some friends and they're like, why is gasoline so expensive? And I said, actually, it's very cheap right now because they're releasing the SPRs. So if it didn't do that, it'd probably be $10 a gallon. Okay, Paula wants to know, how do you feel about graphite and or titanium?
Well, graphite falls into that energy metals, energy materials realm, and naturally bullish on that. I think copper will be one of the big winners, if not the big winner in that whole sector. But yeah, graphite's thrown in amongst all of that, and it's going to be growing. The market for graphite is going to be growing by about 5% compounded every year for the foreseeable future. So I do like graphite in general. It's a niche market. It's hard to find well, you can find graphite plays in the junior mining sector, but it's not getting as much attention as it has in the past. If you're looking at a niche market, titanium is about as niche as you get. There's not many ways to play titanium. There are no ETFs and no physical ways to do it. There are companies involved in titanium, but many of them, if not most of them, are involved in titanium oxide, which is not what I guess the viewer is questioning here, looking at the metal itself, which has a lot of high-tech functions. We'll see what Apple is going to do to the titanium market, but I don't know of many other ways to play titanium. It is a very, very niche market. And if you're looking to capitalize on supply-demand trends, I think there are a lot easier and more direct ways to do it in the other metals, the energy metals, and of course the precious metals.
Okay, all right. How do you feel about nickel?
I like nickel. Again, nickel's a major component in the energy sector, but a lot of other sectors, like copper, like zinc to some extent, and some other base metals, it suffered from this trend of underinvestment and exploration and development for many, many years. So yeah, I like nickel for the longer term. It's got a ways to go to reach past highs. There are some major strategic nickel deposits out there that need higher prices to get developed, and these companies are really plays on that. They're kind of, the optionality plays on higher nickel prices. So there are ways to play nickel, unlike say titanium, obviously, but there are some clearly identifiable large scale, lower grade nickel deposits. And if you want to play nickel for the long term, say 5-year time horizon, I think some of those companies are great ways to do it.
Okay. All right. So what we've learned from this is Brien is really bullish on gold, silver, copper, and some of the other ones we mentioned as well, nickel, zinc, possibly graphite. Is that accurate?
Yeah, it sounds like I'm not being very picky, doesn't it? But but yeah, I think we're in what I would call what I have been calling a generational opportunity. in metals, in mining, and I bifurcate that into precious metals, really just gold and silver for monetary reasons, and then the supply demand imbalance for just about all of the energy metals and base metals out there going forward. So it may be, with those two big driving factors, a new era of commodities going forward, but I believe we are there. And particularly, well, in the precious metals, we're again very, very near all-time highs, so we won't need a long-term price uptrend. If we have gold posting a 2 or 3 week rally at these levels, we'll see that gold mining sector, gold and silver sectors absolutely explode. That's all we need right now, and so we're kind of feeling forward in the future for what that precipitating factor will be.
Okay, awesome. Okay, now go ahead and tell us about Gold Newsletter. You've been nice enough to give the Hive a 30% discount if they sign up. What can we get when we sign up for Gold Newsletter, and tell us about it.
Well, again, it is the oldest precious metals advisory in the world. We cover obviously the metals, but we have a broad spectrum of metals and mining that we cover. We delve into everything from uranium to the energy metals, the base metals, etc., and obviously a focus on gold and silver. We cover the macroeconomics every month in the newsletter, drill down to how it will affect the metals prices, and then we cover a number of what we think are the best junior mining companies out there, the kinds of companies that can deliver, multi-bagger returns of 4, 5, 10, 20%. We recently closed out a 55-for-1 winner in Great Bear Resources last year, and we're trying to put in our picks, combine the macroeconomic picture with the power of discovery by finding the best companies and management groups out there that are making the discoveries that can really make a difference.
Awesome. Awesome. All right. You get 30% off if you use the link below. And tell us about your New Orleans investment conference coming up. It's going to be November 1st through 4th. You got a rock star lineup here. I mean, Rick Roll,
Yeah, isn't that
Gammon.
something?
It's amazing.
Well, Steve, I've been in this business close to 40 years, and I listened to and watched and heard all of the best thought leaders and analysts out there. And, I'm a real fan of everybody we have speaking this year. I think it is the best lineup, not only for the New Orleans Investment Conference, but likely for any retail investment conference out there. These are the people that I know are the best. And, you see the picture there, you see the people that are coming, and behind that we have 2 or 3 times as many experts and newsletter writers. We just couldn't fit everybody in one banner. It is an incredible lineup, and I say that with some pride because I picked everybody that's speaking this year, and I just think they're the absolute best. I could go over every one of these speakers and tell you why I picked them, but I urge people to go to our website and go to the link that you're going to provide and look into the backgrounds of these speakers and see what they're saying, and you'll quickly see why they were chosen to speak at this event. It really is. It's not just the investment event of the year. I think it's the investment event of the past 20 years, because we are at a generational point, a generational opportunity in the markets right now. And these are the people who really have their fingers on the pulse of what's happening and what's going to happen. It's just, as you say, a rock star lineup.
Jim Rickards, Rick Rule, George Gammon, Brent Johnson, Peter Schiff, Lynn Alden, just to name a few. So super excited about that. You also have, if we can't make it to New Orleans, you have a virtual conference as well, correct?
Yeah, they can sign up for a virtual conference, and importantly, not just for the virtual attendees, but those who are in person. Every moment from the workshops to the general session presentations are recorded. So that archive alone, and even last year's archive, which is also available to registrants, is really invaluable. I mean, you can't put a price on it. It is amazing. I would encourage people to come to the event because there's so much more that you get out of actually being there. The intellectual energy, the ambiance of all of these big thinkers and smart investors, smart fellow attendees, gathering in New Orleans in this semi-exotic location. It's really something to experience. You get so many ideas from your fellow attendees. You get to mingle and talk to these big name speakers and get your questions answered. We have a lot of opportunities, from speaker tables to breakout sessions to workshops to social events. So it's something that really needs to be experienced in person to really be believed and appreciated.
Awesome. Look forward to it. Thank you, Brien. If you're going to go to the conference, Brien's been nice enough to kick a little bit back to the show when you use the link down below. So support your favorite podcast and use that one there. Brien, any final comments before we sign off?
Well, for the New Orleans conference, our room block is closing soon. It's great to be in the host hotel, take an elevator to the show and be able to come early and stay late. So I would advise people to register as soon as possible because you do have that special link. And in general, prices will be rising as the show approaches. It's November 1st to 4th. So I would try to share a bit of urgency. Think about it, but don't think too long. Come on down. And if you don't find it to be worth many times what you paid to attend, we have a no hassle, no questions asked guarantee. We will refund your registration fee if you're not satisfied in any way. So there's really no risk from that standpoint, and you'll have a blast. And if you're a serious investor, I have to say, I don't know how you can afford not to come, given our lineup and where the markets are right now.
Awesome. Awesome. Look forward to it. Thank you very much, Brien. And thank you for tuning in. Support the show. Hit the like, subscribe, share this with anyone that you think needs to hear it. Have a great rest of your day.